Hey everyone, in today's video we're talking about investing. Hey, I'm Joe Blogs and welcome to The Savvy Squaddy. In today's video I cover the general basics of investing. Here are the timestamps to each section of the video in case you want to skip straight to a certain part. Firstly, what is investing? Investing is using, giving or devoting time and money etc. for a purpose or to achieve something like knowledge or profit. In this video, we'll be talking mostly about investing with regards to money. However, investing is not a get-rich-quick scheme. It's a way to consistently grow the wealth you already have, and the great thing is, you don't have to have a lot of money to get started. It is also risky. There is every chance you could lose your money, as well as gain money. Investing should only be done with money you don't need for the next 5 years or more. So, now we know what investing is, what can we invest in? You can invest in nearly anything in some shape or form, but the most common things to invest in are shares, bonds and funds. Shares are a small divided up piece of the value of a company. If a company is worth £10 million and has 5 million shares, then each share would be worth £2. If you had one share in this company, then you would own 0.0002% of it. If some good news struck and the share price went to £4, the value of the company would double to £20 million. But there would still only be 5 million shares, and you would still only own 0.0002%, but you would have doubled your initial investment. This can be a very risky way of investing if you don't do your research and have a solid understanding of the company that you are investing in. Bonds, on the other hand, are considered to be quite a low-risk investment, but the gains generally are not as substantial as with shares. A bond is normally issued by governments or corporations when they want to raise money, so essentially you are loaning your money to them, and in return they agree to pay you back the loan with interest. Unlike shares, however, bonds issued by companies don't grant you any ownership rights within that company. A fund is an easy and convenient way to invest, especially for beginners. It contains tens, hundreds and even thousands of different stocks and bonds. Therefore, when you invest in a fund, you own a small piece of a lot of different companies. This is a much safer way to invest your money than into individual stocks. An index fund tracks the performance of a group of stocks. The FTSE 100 and the S&P 500 are both common index funds. The FTSE 100 tracks the top 100 UK companies and the S&P 500 tracks the top 500 US companies. Supply and demand are what controls the price of a stock. If people are buying the stock, the price goes up, and if people are selling the stock, the price goes down. What drives people to buy or sell a stock can be anything from a good or bad news story, quarterly earnings, and even FOMO, which is fear of missing out. Now that's out of the way, how do we invest? Well, before putting up any money, you want to work out your risk tolerance. This is the degree of uncertainty you are willing to take on to achieve potentially greater rewards. Risk tolerance can be tricky to gauge, but I've linked below a quiz to Rutgers University, which may help you figure out your own. Generally, the greater the risk you take, the much bigger the potential rewards, but equally you are open to much bigger losses. And the less risk you take, the smaller the reward, but your money will be a lot safer. Now that you've worked out your risk tolerance, you can now decide what platform you want to use to start investing. Online platforms like Vanguard, eToro, Trading212, Stake, and so many more all facilitate investing. And I mainly use Vanguard and eToro. Once you pick a platform, set up an account, deposit some money, and start investing. Bear in mind that some platforms do have a minimum entry deposit, which varies from platform to platform. Some platforms like Trading212 have virtual accounts, so you can practice investing without the fear of losing your money. You do not need a lot of money to start investing. Not all, but many platforms today will allow you to buy fractional shares. This means that if a company's share price is £500 per share and you find that too expensive, you can still invest in that company with just £5 and own a very small portion of that one share. But you may be thinking, why should I invest? It comes down to what are your goals and financial situation. If you have consumer debt, in my opinion, the priority is to pay off that debt. I'll be making a future video all about debt, so subscribe if you want to see that. If you need the money in less than 5 years, it's better to put it into a savings account, as potential volatility in the stock market may not always give you great returns over the short term. However, if you want to put your money somewhere for over 5 years to build a retirement fund or to grow your wealth, then investing in the stock market will give you much greater returns over the long term than a savings account. Another reason to invest is to try and beat inflation. Inflation is the measure of how much the price of goods, such as food or televisions, and services, such as haircuts or train tickets, has changed over time. An example that many of us can relate to is the price of a Freddo. It was 10p in 2005, and since then it has increased by nearly 2p a year, with it hitting 30p a bar in 2017. In 2019, the average UK savings account interest rate was 1.39%. The average inflation rate was 1.79%. So if you had put your money into a savings account at the start of the year, your money would have lost purchasing power as it can no longer buy what it could have at the start of the year. Investing long term will generally return a much higher percentage than inflation. So now you know all that, when should you invest? There are two sides to this question, the first being at what stage in your life, and the second being if there is a specific time in the day that is best to invest. When it comes to age, you can start investing at whatever age you want as long as you're over 18. There's no right or wrong age to start investing, but generally, as with most things, the earlier the better. You can be a bit riskier if you start younger, as you can be in the market longer and so can ride the ups and downs and see greater returns than that of someone who started in their 40s. The saying, time in the market beats timing the market, is very apt for the second part of the question. No one can accurately predict the future price of a stock, although many people try to do so. By pulling out of the market as soon as a share dips, or trying to second guess when a share will reach its peak, you could lose out on sharp recoveries or see the price go down again. The best way to invest is on a regular basis, so you're buying when it's high and when it's low. This will then give you the added benefit of something known as pound cost averaging. To help explain this, we have two guys, Joe and Gary. Both of them have £12,000 to invest. Joe puts all of his money in as a lump sum in January when the share price was £10, thus giving him 1,200 shares. Gary, on the other hand, decided to put in £1,000 a month for the whole year. The price of the stock went up and down throughout the year, and Gary was buying on a regular basis, capturing these moments. By the end of the year, Joe has 1,200 shares, but Gary has 1,230 shares. He has more shares without spending any extra money because he knew investing on a regular basis over a long period yields better results. And now to finish up, here are some general guides for investing. You don't need a lot of money to start. If you don't need your money in the next 5 years, then invest it, the longer the better. If you are a beginner, use a virtual account to get to grips with it all before you start using your own money. Only invest what you can afford to lose. Work out your risk tolerance. And as a beginner, you won't go wrong investing in index funds. Invest regularly and consistently over a long period of time. Try and pay off any consumer debt first before you start investing. And remember, this is not a get-rich-quick scheme, it takes time and patience. Unless using a stocks and shares ISA, you would have to pay tax on any dividends or profits when you sell. Don't allow your emotions to control your investment decisions. And lastly, I am not a financial advisor, just some guy on the internet. Do your own research before making any decisions. That's it from me, guys. Thank you all for watching. Let me know in the comments below if you've already started to invest or you're thinking about it. See ya. Thank you all for watching. If you liked what you just saw, please hit the subscribe button up there. And if you want to see some more videos, click over there. See you soon.